welcome here, and also welcome back for those of you who were here before lunch when we had a political panel. And that's still available if you want to understand the Swedish context. It was very, very good. But now we have 3 presentations in the afternoon. And I'm Simon Vinji. I work for a union within SACO, so as a chief economist. And we were happy to host this together with the Tax Observatory, of course. We're here in Stockholm.
Yeah, indeed. As a way of introduction, maybe I should say just a couple of words on behalf of the EU Tax Observatory. Firstly, what an absolute pleasure to be here in Stockholm and to co-organize with SACO. The EU Tax Observatory is a relatively young institution, has been going on for about 2 years. But we are already highly impactful on the studies that we do and on the events that we organize. This has been a very fruitful collaboration with SACO. So I would like to thank Simon and my colleagues that have worked for this, and of course the speakers that have traveled from far to bring very important research insights. We have several events coming up and several studies, but mostly we are focusing on corporate tax evasion and tax avoidance, with a particular focus on EU countries. But we're slowly expanding our work as well at the global level. With just a few words so that you know what the Tax Observatory is, I would like to hand over the floor to my colleague Mona Barake. Or you would like to introduce formally first the speakers?
I think we could say all of the 3, so we get an outline of the day. So we have Mona Barake, who is at the Tax Observatory as a postdoctoral researcher. And then we have Piers O'Reilly. Welcome here. You're head of business and international taxes unit at the OECD. And then we have Shafiq Hebous. You are a deputy division chief at the fiscal affairs department at the IMF. Welcome here. And we're happy to have you. And without further ado, the plan is to have, we have around 30 minutes for each of you. So you will present roughly 20 minutes. And then I will be happy to have your online questions.
Yeah.
So what you do is that you enter, you have the information online, but you enter menti.com and the code 31275582. And you just write out there, and we get all of them, and we try to pick the best questions for the researchers. So,
could you repeat the code?
Yes, the code is online, but it's 31275582. Menti.com. Mona.
I'm very happy to be here today to present to you some work that we did with some of my colleagues at the EU Tax Observatory on the 2-pillar solution. So the presentation is going to be based on 2 papers. One is on the Pillar 2, the minimum tax, with my co-authors Paul-Emmanuel Schuch, Theresa Neef, and Gabriel Zuckman. And the second one that we just released on Monday is about the Pillar 1, and it's with my co-author Elvin Le Pohayer. So just to give you an outline of the presentation, I'm going to first start with a quick background on how we arrived to this 2-pillar solution, then the definition quickly of Pillar 1 and Pillar 2. Then I'm going to show you how we estimated the revenues, the main data sources, methodology, and the key findings. And then we're going to move to Pillar 1 and do the same, and then we conclude. So how we arrived to this 2-pillar solution. First, following the financial crisis, the G20 countries put tax at the top of their agenda with the fight against tax evasion and tax avoidance. And then the OECD and G20 launched the BEPS project with 15 different actions. One of them is the Action 1, addressing the tax challenges from the digital economy. And this led to Pillar 1 and Pillar 2 that we proposed. And there was the US guilty that the US, through the Tax Cuts and Jobs Act, imposed a worldwide minimum tax on foreign earnings. So it's not quite like the Pillar 2, but it's like a global minimum tax as well. And then recently, so in 2020, the OECD launched the economic impact assessment of these two-pillar solution, and we had the first joint statement agreement among more than 130 countries of the inclusive framework. And the EU, also the European Commission, proposed a directive that was in 2022 recently approved. And for the pillar one, it's still ongoing, and the design is not yet set, but it's still being, designed. So, what are pillar 2 and pillar 1? If we start with pillar 1, it's actually the idea of it is to allocate a share of the excess income or profits of the most profitable and largest multinationals in the world to the market where the final user is. So, for example, if we take Google or Facebook, they are worldwide and they are digital and they are operating, in many countries, but they don't necessarily have a physical presence. But if you're using Facebook in a let's say African country, but they don't have a physical presence there, this country will be losing taxes because Facebook or Google are not present there. So pillar 1 would allocate taxing rights to these countries. And pillar 2 introduces a global minimum tax of 15% on corporate profits, also of large MNEs. And so if a multinational, let's say, operates and has an affiliate that operates abroad, and this affiliate is paying less than 15% in taxes, it will have to pay a top-up tax. So now we're going to focus a bit on the pillar 2, and I'm going to present to you the revenue estimates that we have. But first, so how did we arrive to our revenue estimates? We used the OECD aggregated country-by-country report statistics because, as you know, so ideally, of course, it would have been much more interesting to have data on each multinational. So we are able to see each multinational where it operates on a country-by-country basis, so we're able to calculate the effective tax rates. But fortunately, we don't have access to such data. So we use the aggregated CBCR. And so the available 2 years that we used was 2016 and 2017. So unfortunately, so of course, these are, we tried as much as to have good estimates, but probably with some newer data in 2020, it would be maybe more specific. But so far, so we used the 2016 and 2017 data. And the first step, of course, to be able to assess the pillar 2 is to assess the effective tax rates of the different multinationals. And to do so imagine, you have a Swedish multinational, it's operating abroad. You need to calculate the effective tax rate in each country where this multinational is operating. But this is in one scenario that is called the income inclusive rule, the IRR. Oops. And so if we move to the QTMTT scenario that Emile talked about, we will have like a different approach. So instead of this top-up tax being collected from affiliates abroad, it will be the host country, that will collect this difference. So in that case, if we are in Sweden, let's say, we will look at the foreign affiliates that are in Sweden. If they are not paying 15% on their profits, then they would pay it directly to Sweden, not to the country of headquarters of this multinational. So what we did is that since there's these two scenarios, and we don't know yet which countries would choose QTMTT and which countries will end up using the IRR scenario, so we actually estimated revenues for both separately. Of course, in a practical scenario, maybe it will be some countries applying IRR, some others QTMTT, but we modeled them separately. There's also an interesting thing about Pillar 2, which is called substance-based income inclusion or carve-outs. So once you calculate the ETRs, you see that, let's say, okay, the ETR is less than 15%, you want to apply the top-up tax. But when you are going to apply the top-up tax on the tax base, you will end up, from the design of Pillar 2, you have to actually subtract an amount, which is in short term 8% of tangible assets and 10% of payroll, and in long term 5% of tangible assets and 5% of payroll. So of course this will reduce the amount of the revenues that countries will get. Now, if you move to the key findings from Pillar 2, so the top 10 countries are presented in this table here. We have, of course, the US that has around 54 billion, and that is explained by the fact that the US has a lot of multinationals, so they have a very high number of multinationals, and many of them also are operating in low tax countries, which leaves them room to collect revenues. But if you see, when you move actually to a QTMTT scenario, so in that case, it's actually the US who is trying to collect revenues from the foreign affiliates of multinational in its country, it will drop significantly from 55 billion to 3 billion. So for the EU, under both scenarios, they will get almost the same amount of 50 billion euros, but the distribution of the revenues, of course, will differ across countries. So for the EU, if we move... So for example, before moving to the next slide, if we look at Germany, if Germany is gonna ask its multinationals, the foreign affiliates abroad to collect taxes, it's gonna gain around 11 billion, but also it's gonna drop under the QDMTT because not so many affiliates are paying low taxes in Germany. And you could see that for Netherlands, for example, it's gonna be the inverse. Because they're gaining 2 billion under the IRR scenario, but it's going to increase significantly under QDMTT because they have many foreign multinationals that are operating there. Now, before moving to the Swedish revenues, if you want to have like a sense of the global distribution of these tax revenues, we can see that so under both scenarios, the headquarter or the QDMTT, we have developed countries that will benefit the most with 133 billion. Most of these profits are actually collected by G7 countries, which is driven by the US because the US is collecting much of the revenues. And under the QDMTT, it falls, of course, from 133 to 95. And it drops significantly for the G7 countries because of the drop for the US. For developing countries, we see that it's 21 billion under the headquarter or the IRR scenario, and it increases a bit under the QDMTT. For the least developed countries, like under the headquarter scenario, we think that they're not really going to collect any revenues, but under QDMTT, they're going to collect just a bit of a slight revenues, but it's not significant. Now, if we have a look at the EU under both scenarios, so as I mentioned, the total is not going to differ much, but between 55 and 54 billion, but the distribution is going to be a bit different because if you see Ireland, for example, it's not a very good example, maybe. So let's take again Germany from 10 to 5. What do we have as well? France from 3 billion to almost to 0.2. Sweden from 2.3 to 1.7. And we have, on the other hand, countries like Luxembourg, no, not Luxembourg, maybe Malta, it's going to increase a bit. So we will see that actually between these two scenarios, the countries that have low taxes will benefit most under QDMTT, and the ones that have, that are, economies with higher taxation will benefit under the headquarters scenario. Now, if we focus a bit more on the Nordic countries, since we're in Stockholm today. So for Sweden, Emil had showed us that the Ministry of Finance had an estimate of 0.5 billion. and we have an estimate of 2.3. So the reason why there's a difference between the two estimates is because we use the data, the CBCR data, the aggregated one for the year 2017. But from my understanding is that the Swedish Ministry of Finance, they are using the micro CBCR for the year 2020, which gives them a much more detailed assessment of Pillar 2. So of course, if we had this data, we would have preferred to use it. So maybe this scenario is not actually pessimistic of the Ministry of Finance, because there's also another issue that drove our results a bit upwards, which is prior to 2020, in the data that we use, there's a problem of double, like the profits sometimes are not reported in a correct way. So but we tried to correct for this, and we ended up with the 2.3 billion for Sweden for here. But probably the 0.5 is going to be closer to reality. Also, what is interesting to see is that how many multinationals Sweden seems to have. They have 103 MNEs that they can, apply this minimum tax on. On the other hand, there's around 800 multinationals that are operating in Sweden, and maybe maybe half of them are American. The same for Denmark, Finland, and Norway. So of course, for Denmark, Finland, and Norway, we can see that they have less MNEs than Sweden, and as well for the also MNEs that are operating in Sweden. Now we move to Pillar 1 Amount A, which is the reallocation of taxing rights. So also very quickly on what is Pillar 1. So as I mentioned before, we need to reallocate part of the excess profits to the countries where the final user is. And in order to do this, first we need to know which multinationals are going to be affected. And to do so, the multinationals in the design of Pillar 1 should have revenues above 20 billion euros, and they should also have a profitability above 10%. And the Pillar 1 excludes all the banks, financial services, and extractives industry. Then once we know who are the multinationals that are covered or in scope for Pillar 1, we can, based on the design and the rules of Pillar 1, we can calculate the profits that are going to be subject to this reallocation, which is going to be 25% of the excess profits. The excess profits are calculated as profits minus revenues times 10%. So this is considered, this first part, as the excess profits, and the second part is 25% of this excess. Then, in order to arrive to the net gains from Pillar 1, we should, of course, so once we reallocated these profits, each country needs to tax them, and we assume that they're going to use the CIT rate. But then in the design of Pillar 1, there's something called obligation to eliminate double taxation, which is tax reliefs, because in contrast to Pillar 2 actually is a top-up tax, so it's going to increase the burden of taxes on multinationals. But Pillar 1 is not designed to do this the same thing. It's designed just to reallocate taxing rights, and that's why in the design it offers this obligation to eliminate double taxation or tax reliefs. So from one hand, you have new taxing rights and some countries that are going to tax some revenues, and on the other hand, you have some countries that will have to kind of repay the taxes to the multinational. So I'm not going to enter, of course, into the it's a very complicated rules and design under Pillar 1, but just to give you a sense of what we did. So we first assessed the reallocated profits, and to do so, we tried to check where are the sales of each multinationals in the world. Then we used for each country the CIT rate. It's like, so the country received the money and the revenues and taxed it. Then we assessed the obligation to eliminate double taxation. And to do so, so how does this elimination works? Countries with the highest profitability, so multinationals with the highest profitabilities in country J, will be the one that have to offer these tax relief in priority. So that's why this will affect, countries with where they have a very high return on assets and employees. So what in this table I will show you the how the covered groups are among countries, which one are going to be in scope. So for the US, we can see that most of the companies that have to abide by Pillar 1 are American or Chinese. 31 covered groups that are American and 13 are from China, and the rest are from some European countries like France, Switzerland, UK, Germany, Ireland, and Spain. We don't have any Swedish multinationals that is going to be under Pillar 1 because there's no one that passed our threshold of 20 billion euros and 10% of profitability. And you can also see that for the amount A, so this is how much from each covered groups of each country, how much is going to be reallocated. The total reallocation amount is going to be around 94 billion euros. But of course, this is not what countries will get. This is just how much will be reallocated before the profits are taxed. Once they are taxed, you can see that this 94 or 93 billion will be reduced to 24 once each country tax it. And then you have the elimination, which corresponds to the same amount approximately. And then you have to assess the loss, which is you eliminate with respect, we assume that it's going to be with respect to the effective tax rate, and then we arrive to the net gain. So again, the net gain is the difference between what has been reallocated to countries once they taxed these reallocation profits, minus how much they need to offer as in tax reliefs. So we arrive at a total of 15.5 billion for the whole world, which is around 0.16% of the total taxes on average. And you can see here in this table the top 20 countries that would benefit from Pillar 1. And again, we can see the US, and that is explained by the fact that the US has a very large market with a lot of consumers that have a high also GDP per capita. Then you have China, Germany, etc. Also, an interesting thing to look at is that the EU would gain a total of 2.5 billion. The OECD countries 13. So I'm looking at the net gains. The OECD 13.2, and tax havens, so countries that we classify as tax havens, are going to lose 1.2 billion. So we can see that for tax havens, the loss comes from the fact that they don't have a lot of reallocated profits, and they have a huge amount to offer tax reliefs, 61 billion, which is going to be a loss of 2 billion because they have very low effective tax rates. If they had even higher tax rates, the loss would have been even much more bigger. So yes, this is the elimination. And then, so allocation among countries. We can also see that developed countries are the ones that are going to gain the most. And so as we can see, the net gains are 12 billion. For developing countries, it's going to be around 3.5, and it's mostly driven by China. Then for least developed countries, it's going to be 31 million. In relative terms, it's going to be almost the same because you have for developed countries 0.17% of total taxes, for developing 0.15%, and for least developed also 0.15%. And that is explained by the fact that usually developing and least developed countries, they don't have a lot of tax revenues. And even though the net gain seems very, very low for them, but relatively to how much they are collecting taxes, it's still a bit comparable with developed countries. Now, for Sweden, so how much they would collect from this Pillar 1 they will have a net gain of 86 million. So it's very, very little with respect to even the 0.5 billion of the Ministry of Finance. And then Finland 28 million, Denmark 34, Norway 45, and Iceland almost nothing. I mean, 1 million. And as a percentage of total taxes, you can see 0.07% of total taxes. So in conclusion, the total revenues from Pillar 1 are estimated to be around 15.5 billion, which is much more lower than what is expected under Pillar 2, which is 154. The revenues for Sweden are expected to be 2.3 billion, at least in the data that we have currently, and 0.09 under Pillar 1 euros. The amount aims to redistribute taxing rights rather than to generate revenues like Pillar 2, which is a top-up tax. And Pillar 1 puts the burden of this double tax relief on jurisdictions where multinationals have high returns on substance. So this is in the investment hubs or in tax havens. And also something on Pillar 2. So these carve-outs, the substance-based carve-outs, can also shape incentives because maybe multinationals will have some behavioral responses to move their assets or employees. And the choice also whether a country will apply QDMTT or the headquarters scenario, the IRR, also might affect the final outcome of Pillar 2. And another uncertainty from Pillar 2 comes from the fact that how the US GILTI top-up tax will coexist with the Pillar 2 design. And finally, as was mentioned by Emil and the speakers in the debate, the two-pillar proposal expected to have an effect on profit shifting. But this is, of course, it's very soon to say because there might be a lot of behavior responses. So generally, it might decrease profit shifting, but there was a research assessing the effect of GILTI on profit shifting, and the results seemed not to be very promising. So let's see how it's going to end up with this two-pillar proposal. Thank you.
Thank you very much. And I think we have a few questions from the floor. Do we have anyone in the room? Yes, we have one in the room. Should we start with you? We have to wait for the microphone, sir.
I just missed which data set you used for Pillar 1.
For Pillar 1, yes.
Sorry.
We used we used several databases to know the sales of the multinationals. We wanted first to use the OECD CBCR database, but the issue is that because it's not destination-based sales, it doesn't really reflect where the final sales are happening. So we took the OECD AMNE database because it offers the output of multinationals by country and sector, and it offers also the exports. So we were able to assess kind of a proxy of the destination-based sales, because this is the hardest thing in Pillar 1 is to know where the real sales are happening, because it could be a multinational, selling to a market, but registering the profits in another country. So this is really the hardest thing in Pillar 1. And we used the AMNE OECD database and removed the exports from the output of each country. And we also used then to calculate the elimination of double taxation or the tax reliefs, the OECD CBCR database to know where the employees and the assets are.
So one more from the floor, and then we have from online.
Thank you. I'm Johan Fall from Confederation of Swedish Enterprise, and thank you for an interesting presentation. A lot of numbers, and I think it was very comforting to hear that you kind of step back from your numbers, that they're probably exaggerating this a lot. Just to make something clear, I mean, you mentioned several times that the Swedish governmental inquiry found out a much lower number, and your number somewhere 2.3, but the Swedish number is not 0.5, it's 0.05. So the fact that your numbers are not 4 or 5 times too high, but actually they are 40 or 50 times too high. So just something to keep in mind, that there are a lot of numbers, but I don't think you can use them actually.
Yes, we are trying to. So the purpose of doing the estimations is to have like a floor to know what might countries get. It, of course, because of there might be a lot of behavior responses or, changes in the application of the final rules. So it might not look like this exactly, but this is just like a general idea of the results. But one thing is that I think in the report of the Ministry of Finance, what they did is that they offered estimations over a period of time. And in the period that corresponds to ours, the revenues were actually high, but then they decreased because of either the quality of data or this double counting of dividends. So...
Maybe I will ask a question because it's on this as well. Just as a follow-up, could it be that it could be explained by an economic fluctuation because it's on profits of multinationals? So if you take some years and you go back, we used the years of 2016 to 2017, but then we're looking at the COVID years essentially, where some of the profits were reduced. So could economic fluctuation explain what the difference is?
I think many factors would explain, but mostly maybe it's the quality of data as well after 2020, and also maybe some losses from the COVID period. And maybe you had a question.
To answer you on, it's correct that the number is 0.05.
Okay.
That's because we think that Sweden will not take all the revenue. If you go back to the macro number, then it's your number, 0.5 for 2020.
Okay.
And you're right, it's different effects. One is the double counting of dividends. Another thing that we see that the amount of profits that the multinationals are reporting outside Sweden decreases substantially 2020, and the pandemic effect. So it's a combination of everything. But if you go down to the micro level data and the origin of the profit, and assume that other countries will also implement Pillar 2, or those that announce that they will implement will do it, then Sweden will not gain anything, almost half a million. Yeah, thank you.
Thank you. And we have one last question from the internet.
There's an online question on basically the difference between the IRR and the QDMTT. Someone asks online, is the QDMTT anyhow not the most probable scenario? And why would countries under tax subsidiaries when these would be taxed higher in the home country anyway?
So for the first question on the difference between the IRR and the QDMTT, in the first scenario, the IRR, it's actually when a multinational that is, let's say, headquartered in Sweden will go to its different affiliates around the world and see the ones in some countries where they are paying less than 15% of effective tax rate, and they will collect the difference, and this difference will go back to Sweden. But in the QDMTT scenario, it's actually the opposite. So this multinational of Sweden, let's say it's operating in country X, and it's paying less than 15% of taxes. Instead of this money to flow back to Sweden under IRR, in the QDMTT, it's the host country that will have the priority to raise, either to, of course, raise taxes or to apply the QDMTT and to collect the top-up tax itself directly. And for the second question, it was, Panos, can you repeat it a bit, please?
Yeah, why would countries under tax subsidiaries, when these would be taxed higher in the home country anyway?
Yeah, I mean, maybe I'm not getting the question, but let's say it's if you have a multinational and it's operating in the Cayman Islands or in, you know, like a tax haven with a 0% tax rate. So in that case, there would be a lot of, you know, there would be an incentive for the multinational to probably to go and have a subsidiary there, even if in the home country the tax rate is high. And in that case, the headquarter scenario, the IRR, will be very beneficial for the country that will collect it if the Cayman or this very low tax countries do not want to do so.
Thank you so much.